Welcome to The Beat, your go-to where leaders, founders, and investors share insights on growth, innovation, and business building. I'm Chitra Nabat, your host. Joining us today is Yuechen Zhao, GSR Ventures partner. Yuechen, welcome. Thank you for joining us.
Thank you for having me.
What is GSR Ventures, and what's differentiated about your firm and investing approach?
GSR Ventures, we're an early stage venture capital firm. We're based in the San Francisco Bay Area, and we invest a lot of our time and attention to digital health and health tech. I think one thing that's a little bit unique about us is that we're a very nerdy bunch. And so with me on the team, I actually have 3 other partners who all come from the healthcare world, all are trained clinicians, trained physicians, just decided to join us and do healthcare investing instead of going to clinical practice. And I'm the one that has a little bit of technical experience, technical background, having studied computer science, done engineering, product management, and worked in various tech companies and startups before joining the firm. But we all kind of come together to invest in healthcare with this combination of healthcare experience and technical experience. And when a lot of founders meet us, entrepreneurs meet us, they tell us that just the types of questions that we tend to ask are a little bit different. The interactions that they have with us tend to be a little bit different. And at least they tell us to our faces that they like those interactions. So I think that that's what makes us a little unique.
So when they say you're different, from your perspective, how do you compete? How do you compete and punch above your weight to attract the best founders?
I think for a lot of founders and investors, how I like to think about the relationship is that it is really a decade-long or 2-decade-long commitment to each other. And so to me, it's not really about the name or about the, in some respects, it's not really even about the resources that a firm may be able to give you. It's about, are you really going to be able to get the support that you want from that long-term connection? And each one of us, we make it our goal to be the best long-term partner we possibly can. And that means supporting our entrepreneurs when they need to be supported, challenging them when they need to be challenged, and acting as that trusted long-term advisor and partner to them. And I think when they speak to us, just because of the way that we think and because of our background and because of the things that we like to think about and talk about, they just find that we can act as really good long-term partners and they can trust us for the long term. I think that that's the most important thing to me.
When you talk about investing for the long term over 1 and 2 decades, right now the investing climate is very challenging. Last year saw the lowest amount of capital invested in US digital health startups in 4 years. VC funding and deal volume sunk more than 60%. VCs, including the big brand funds, have written down big portions of their portfolios. And more than 130 health tech unicorns have their valuations plummet by more than 50% in the last couple of years. What's been the experience at your firm?
I think for a lot of our companies, look, some companies did manage to raise capital when markets were good and didn't spend that money well and maybe have had to shut down or sell, right? That's, I think across the board, that's happened at that's happened for a lot of companies, and for some of ours, that's been the case as well. But for others, they raised a significant amount of capital when markets were good, and they still have that capital in the bank. And what we've been working with them on is really making sure they're being efficient with the way that they're spending their money, and they're being efficient in the way that they grow, such that they can rely on that capital for years to come without having to go back to the market to raise more money, which I think is where the problem is going to lie if the valuations have changed so much. Fundamentally, these companies are still good companies. They're still great teams. They're still going after really important markets. They're still selling products that their customers really want and need to run their own businesses. And so I think what made them great companies hasn't changed. The valuations have changed, but that doesn't matter if you just focus on building the business and use the capital that you've already raised to make sure that you propel yourself forward.
How has your firm been impacted by valuation write-downs in your portfolio companies, and how has that impacted or changed your investing approach?
Look, I mean, markets change. Public markets change, private markets change. Our LPs understand that as well, right? Everybody understands this. And so when we look at our funds, we really look at it from a long-term perspective. As long as these companies can generate a significant return over a decade or more, a write-down in the current moment doesn't matter, right? If you hold a stock portfolio and your stock portfolio is dipped down, but if it's going to recover and continue to generate returns for you in the future, that also doesn't matter. And so I think for us, we don't really care about what's happening in the current market. Now, translating that into how we invest, that also hasn't really changed how we invest either. Because when markets were high, we were pretty careful about where we were investing. We thought that a lot of the valuations were pretty unsustainable. And then now that markets have come down a little bit, I wouldn't say that it's actually come down a ton, it's come down a little bit. I think for us, it's like, all right, well, the valuations are a little bit more manageable. Let's go look for companies that are really going to be those return drivers. But it's still very, very hard for us to find entrepreneurs and find opportunities we can truly be excited by. Those opportunities that can generate, over the long term, be able to hit like $1 billion in revenue or more and to really make a huge impact in the world. Like those opportunities are very few and far between, no matter what the market looks like. And so I would say our investing pace probably won't change too much. May speed up a little bit because the valuations have come down a little bit more favorable, but in general, finding opportunities continues to be the biggest challenge.
So you just hit the nail on the head there, because analysts say that in private equity, there's more than 650 billion sitting on the sidelines waiting to be deployed. So what will cause you to pull the trigger? Take us into your investor algorithm, your pattern recognition, in terms of what specific types of founders or attributes in their business models that would cause you to pull the trigger.
Yeah, I would say, I think for a lot of VC, because we're looking for those really, really large outcomes, those sustainable, enduring companies that are going to be able to get to $1 billion in revenue or more, those companies, even at the early stage, need to be seeing tremendous market momentum. So what I mean is they need to have hit on something or have a hypothesis about hitting on something that, if it works, will just have customers flocking to them and will just give them such tremendous tailwinds that they can be inefficient in how they run their business. They can be inefficient in how they ultimately go to market with the product, but then the product and the revenues just grow because of that momentum. A lot of that is what we're looking for in a company. But besides that momentum, we need to be looking for founders that are really passionate about the problem that they're solving and want to commit to that problem for a decade or more. They're going to have a business model that allows them to have gross margins greater than 50 or 60%. So that means not a lot of labor, not a lot of human capital, not a lot of very heavy services, because those tend to be harder to scale. And then ultimately companies that have a hypothesis, a good hypothesis for how they're going to be able to defend their product and create long-lasting competitive barriers, which is very tricky for most companies. And I think at the early stage isn't always apparent how that's going to be done, but at least has a hypothesis for how they're going to do it.
Yeah, because we're overwhelmed, we're inundated with shiny objects and in health tech, right? And so over the next 5 years, where do you think there's real money to be made?
Tons of shiny objects, you're right. And here, we're at the conference and every single company has a booth and they all look super impressive. But I think one thing that I've observed is health systems and health insurance companies, they get a lot of mind share when we think about healthcare. I think patients and employers, the ones that are ultimately seeking care and paying for the care, they get a lot less mind share because they don't have these fancy booths at these conferences. They don't have the money to go out and do all this PR. And I think, a lot of the opportunity is going to lie in going back to the fundamentals. At the end of the day, this entire industry is about serving patients. How do we create a system that works better for patients? How do we create products and services that help them seek the care that they need and helps them pay for it and helps them take care of themselves? That is what I'm focused on over the next 5 to 10 years. And I'm excited about some of the new potentials that are happening now with some of this new AI technology that I think is maybe still a little bit too early today, but is evolving very quickly. And so over the next 2, 3, 4, 5 years, what that turns into, I don't know. But I think a lot of the opportunity is ultimately going to sit with the patient, with the employer. And I think, I would love it if more people thought about them.
Any specifics within the AI technology? Any specifics that you're watching closely?
I think, one thing that we've been talking about as a group, and I've been thinking about a lot, is it's still so hard for patients to get appointments, see doctors, when they have a problem, when they have a health problem, right? It's just so much easier to ignore that as opposed to trying to solve it in some way, especially when appointment times maybe are 2-3 weeks out, maybe 5-6 weeks out, depending on your specialty and depending on where you are in the country. And where do people turn to today? They turn to Dr. Google, they go to WebMD, and they look up their conditions, and maybe they take some prescription from their friends and they take it, and that's it, right? That's how they take care of their bodies. But I think with this next generation of AI, there's potential for people to get much better advice from these systems than they have in the past. There's potential for people to get care much faster, much cheaper. And what does that mean, right, for the entire healthcare system? What does that mean for patients in the entire world? I don't know, but I think that's very exciting to me. There's some caveats, right? This technology isn't perfect. There are all kinds of ways that it can make mistakes. So I think we have to be very careful. But just think about a future where care is accessible, literally accessible at the click of a button, as opposed to having to wait 2 or 3 months to get your doctor's appointment.
When do you think the exit window will open up for health tech startups and differentiating metrics required to go public?
The exit window is a tricky thing. People are talking about maybe the IPO window is opening this year. Markets are at record highs. Reddit just filed for an IPO. I think if companies really wanted to go out today, they probably could. I think for me, fundamentally, right, as you said, it is about making sure that companies have good businesses. And I think these good businesses will always have an opportunity to go out. There are going to be times when the markets are high, markets are buoyant. Those are better times for companies to go out and raise. There are times when the markets are low. Maybe they don't want to and they just want to wait. And they'll have the luxury of doing that if they have a really good business. And fundamentally, I think that still means like a business that is growing in a market that really demands their products and services, a business that has really good margin structure, business that has good barriers, good defenses against competition, and a business that is growing without burning a lot of cash, that's profitable or near profitable. I mean, those are still going to be things that ultimately allow the business to succeed and that investors value.
Yuechen, thank you so much for joining us.
Thank you for having me.